What if I told you that trying to predict the stock market is a losing game? Investors panic when the market gets chaotic. Some sell everything. Others try to time the bottom. But billionaire Howard Marks, one of the sharpest minds in investing, says that's exactly what you shouldn't do. In fact, making decisions based on big headlines like war, inflation, or elections. He says that's a fool's game. So what's the right strategy when the market feels unstable? Stick around, because by the end of this video, you'll know how to navigate the chaos without wrecking your portfolio. We've seen it all: COVID-19, the Russia-Ukraine war, rising interest rates, AI hype, and now a stock market that feels like a roller coaster with no brakes. If you're feeling overwhelmed, you're not alone. Howard Marks, worth $2.2 billion and founder of Oaktree Capital Management, believes most investors are focusing on the wrong things. Instead of chasing trends or panicking over headlines, he follows a bottom-up approach, analyzing individual companies rather than trying to predict the entire market. And the best part? His strategy works. So today we're breaking down Marks's approach, why he isn't panicking, and what you can do to protect your money in this unpredictable market. Let's dive in. The biggest mistake investors make. Here's a harsh truth. Most investors react emotionally. A major event hits, maybe a war, an economic slowdown, or an election, and people start making impulsive decisions.
Sell everything. Move to cash. Buy gold. Run for the hills.
Marks believes this is one of the worst mistakes you can make. Why? Because market reactions to major events are unpredictable. Take COVID-19, for example. In early 2020, stocks crashed. Everyone thought we were heading for a multi-year recession. But what happened next? The market skyrocketed to all-time highs in just months. Or consider the Russia-Ukraine war. When it started, people feared a massive economic downturn. Yet many stocks, especially in defense, energy, and commodities, boomed. So what's the lesson? Trying to predict how the market will react to global events is a losing game. Howard Marks says instead of reacting to news, investors should focus on something much more predictable: the value of individual companies. The market is overpriced, but that doesn't mean sell everything. Marks acknowledges that stocks today are historically expensive. The S&P 500's price-to-earnings ratio is well above its long-term average. Big tech stocks? They've been on a rocket ship. But does that mean it's time to sell everything? Absolutely not. Instead, Marks suggests shifting into a defensive position, not exiting the market entirely, but being more selective. Here's what that means. Diversify properly. If all your money is in U.S. tech stocks, you're at risk. Look into sectors that aren't overvalued. Keep a cash buffer. Don't go 100% in. Having some cash ready lets you take advantage of market dips. Think long-term. Short-term fear shouldn't dictate long-term strategy. And here's the most eye-opening part. Marks points to data showing that if you missed just the 10 best stock market days over the past 20 years, your total returns would be cut in half. That's why he strongly advises against market timing, because getting out at the wrong time means missing the biggest gains. With another U.S. election coming up, people are making the same mistake they do every 4 years, trying to predict how politics will impact the stock market. But Marks? He doesn't play that game. His take: presidents don't have as much influence over the stock market as people think. Sure, policies matter, but markets are driven by business fundamentals, interest rates, and global economic cycles, not just who's sitting in the Oval Office. Just look at history. During Trump's presidency, people said his policies would crash the market. Stocks boomed. During Biden's presidency, many predicted an economic collapse. The S&P 500 hit new highs. Lesson: betting your portfolio on politics is a fool's errand. The smart move? Stay invested, stay diversified, and focus on business fundamentals, not political headlines. Now here's where it gets really interesting. While most investors are running away from China, Howard Marks is buying in. Why? Because China's stock market is cheap, really cheap. Right now, big Chinese companies like Alibaba, JD.com, Pinduoduo, NetEase are all trading PE ratios under 20, significantly lower than their U.S. counterparts. Of course, China has its challenges: real estate issues, government crackdowns, and economic uncertainty. But Marks believes these problems are temporary. He sees value where others see fear. And history tells us one thing: when everyone is scared, that's usually where the biggest opportunities are. Is China a risky bet? Absolutely. But for investors willing to take a contrarian approach, there might be serious upside potential. So what does all of this mean for you? Let's break it down. Don't make investment decisions based on fear or news headlines. Global events are unpredictable, and reacting emotionally will only hurt your returns. Avoid market timing. Missing just the 10 best market days in 20 years could cut your returns in half. Stay invested. Take a defensive position. Diversify beyond U.S. tech, keep some cash on hand, and focus on long-term value. Ignore politics when it comes to investing. Elections don't have nearly as much impact as people think. Consider contrarian opportunities. China may be a risky play, but where there's fear, there's often value. Now, I want to hear from you. Do you think the market is in a bubble, or is this just another cycle? Drop your thoughts in the comments. And if you want more insights on investing and market trends, click here to watch my next video.
Trust me, you don't want to miss it.
Smash that like button and subscribe for more deep dives on finance and investing.